All right, we are getting ready. Hello, everyone out there. So nice to see you. Thank you for joining me. You're watching Be the Boss of Your Money. This is my live stream. We have a lot to cover today. You know what the show is about. It's about personal finance, investing, the stock market. Really just helping to give you a full understanding of what's happening with the economy, with the market, but more important, what to do with your investments, your personal finance. We cover everything from the basics because people need reminding. We get into some very advanced, some very sophisticated financial planning and investment strategies, and we do everything in the middle. Today, we are definitely doing something I think is very interesting. It's the Silicon Valley Bank disaster du jour. This is a huge, huge event, and I think the after the bomb that went off, we're going to have to deal with the aftermath, and the aftermath is what to do so this doesn't happen again. And you know, the blame game is going to go around, and we need to examine this because uh, a lot of people feel that this was the spark that would have created another financial disaster, another 2008, 2009 stock market disaster, which would be much worse than we have now. It's impossible to say if it's not. I could tell you I don't think it's that, and I really don't. And there's a few reasons what makes what's happening now different. So I'm going to take a quick rundown. I'm going to tell you what really happened with Silicon Valley Bank. It's actually not a complicated thing. It's really a dumb thing. I'm telling you, it's not as big of a deal to wrap your arms around this. We'll talk about what the contagion means, what contagion even is, what it would have meant. And then, we're going to go into what this means for you. And we're going to do this pretty quickly. Okay. So while you're watching, if you'd like, I'd always appreciate if you give it a thumbs up or whatever reaction is available to you, depending on which social media platform you're watching on Facebook or LinkedIn or Twitter, what have you. Maybe give it a heart or a wow, whatever. Okay. And if you have any questions, please ask in the comments. That's what the comments are for, because I do think I speak this about stuff like this all the time. I was very involved in writing. I wrote a lot of content. I was writing a lot of content for CNBC around the 2008, 2009 financial crisis. And I'm really well versed in speaking about these kinds of things. So if I miss something or there's something that you feel I should go over or you have a question, definitely hit me up in the comments. Just want a quick shout out to Jennifer and to Rianne. It's great to see both of you guys out there. Thank you so much. So first thing I have to do is roll the intro. And then right after that, we're going to get into what happened. It's going to be very simple when I explain to you what happened. And I can't wait to get there. So here we go. All right, we're back. Thank you so much for tuning in. I don't know why the intro is a little bit low on the volume. I'm not sure what I was playing with on my audio, my Rodecaster here for all the audio. So I spoke about this extensively in my radio show this morning, and I've actually have a few things to add to that, which I think will make this show even better in my explanation. And if you connected with me through the radio show, I appreciate you hanging out with me now. And so here's the deal. Silicon Valley Bank did not invest in credit default swaps or some strange esoteric derivatives like what happened in 2008 with Lehman Brothers and AIG and Bear Stearns and Merrill Lynch and other firms. This is nothing like that. What this is a case of mismanagement. So again, we had a lot of things like credit default swaps and these other strange securities, portfolio, insurance, all kinds of weird stuff that were basically helped banks, financial institutions leverage up like crazy. And this is super speculative stuff, which only needed tiny moves in the market, in the bond market or interest rates, what have you, for it to have magnified uh, issues, to have the profits and losses magnified. So when you have magnified losses, banks get into trouble. So it works like this. Silicon Valley Bank did not get into that weird esoteric stuff. They're a bank, so they take in deposits. So you walk into the bank, you deposit money into your account. The bank will keep about, let's say, 10% of that money in the branch. The rest of that money, they'll actually probably keep less of that. They'll probably keep like 2% in the branch. The rest of that money they use to make money on your money. So they buy securities like bonds that yield more than what they're paying you. So if they're paying you 1/10 of 1%, they can invest that money at 2%. They're making 1.9% on that money, but it's leverage, so it's a lot. And banks also make loans with the money that you deposit, and banks are not counting on you taking all your money out. Now, there are some people who do take all their money out of the bank, but when you're talking about millions and millions of customers, there's always going to be money in the bank from people, okay? Silicon Valley, though, is, I like to say, it's the biggest bank that you've never heard of until the last few days. It's actually the 16th largest bank in the United States, which I think a lot of people are shocked when they hear that. They're like, you mean they're that big? They're that big of an institution? Now, compared to the top 10 institutions like JP Morgan, Wells Fargo, Citigroup, Bank of America, PNC, US Bancorp, it's really not anything in size compared to those big banks. But it still is a very big bank in the world of regional banks. So they take in the money as deposits from depositors, but their depositors are different. 95% plus of the bank accounts at Silicon Valley had greater than $250,000 in the accounts, which is the limit for FDIC insurance. By the way, I was asked, what about a joint account? Husband and wife have an account with over $250,000. They only insured for $250,000. In that case, they're insured up to $500,000. Just so you know, I want to just touch on that in case some of you were going to ask, because people have been asking me. And I put a really good post about what's covered under FDIC rules. I posted it today on Facebook and LinkedIn and Instagram. So, go to my profile so you can see what I posted today, and you'll see this nice chart that lists all the different types of accounts, trust accounts, et cetera, joint accounts, individual accounts that are covered by FDIC, and to what the limits are. That you might find that very helpful. So I won't waste your time getting into that now. You'll just take a look after this, okay? And if we're not connected on social, and you're watching me, definitely connect with me. So what happens is this: the 95% of the deposit accounts at Silicon Valley Bank are way above $250,000. These kinds of clients who have that kind of money, they're not like you and me. These are basically startup companies. They're pre-IPO companies. They're venture-backed companies where investors put money together. They invest in these companies. They're, in many cases, they're not proven. They have a business plan that they want to develop. And a lot of these companies are burning through that cash in order to get to their path to profits. So these kinds of customers it's not like they're investing in their IRA and leaving the money for 10 or 20 or 30 or 40 years or even longer. They're putting that money into the bank to take that money out because they're using that money to pay for their current operations, current expenses, like their payroll, their office leases. So when they put that money in the bank, they're taking it right out. But what Silicon Valley did is they took that money and they invested in treasury securities with 3, 4, 5 year plus maturities. So when these bank customers said, hey, we're taking our money out, because that's why the money's there. We're a startup. We're not making any money. We're losing money every month. Every day we open our doors, we lose money. So the only way we could survive is by dipping into our bank account to use that money to pay for everybody, to pay for the expenses of the business. So it's not like sticky assets. It's not like long-term investing. Think of it like this. If you're a client of mine and you have, I'm just going to throw out an example, all right? I don't want to be too big or too small in this example, but let's say somebody has $500,000 in their account with me invested in securities. And they call me up and they say, I need to take $100,000 out of cash to use as a down payment for a vacation home somewhere else, for example. What do? I don't wait. I immediately turn $100,000 of securities into cash because, while the client might need that money tomorrow, they might find that vacation home in a year and a half. That any day I'm going to get the phone call from the client that says, send the check. And I can't take the chance that 100,000 should stay invested for the next, possibly for a year, because that 100,000 could be worth 90 or 80,000 or less in a year. We don't know what the future is going to bring over the short term. So it's not worth keeping that money invested, knowing that the client is going to be taking that money out at any time. And that speaks to the basics, your risk tolerance, your time horizon, your goal. So you have a goal, let's say in a year, and your time horizon is a year. So that is what determines your risk tolerance. So therefore, you don't have a risk tolerance. You have no risk for money that you need in a year. So Silicon Valley Bank should have known, and I'm sure they did know, that their customers are going to need their money near term, or at least they could potentially need it near term. So Silicon Valley Bank should not take their money and invest it into long-dated securities, knowing full well that at any given time, their depositors will take money out of the account. And then the bank will get stuck with the longer-dated securities. What happened is interest rates went up a lot, and those long-dated securities went down in value. Like that example I gave you with that 100,000, I can't take the chance for you that account could be, that 100,000 could be worth 80,000. But that's what happened essentially with Silicon Valley Bank. They put the money into investments that were not a good match for the time horizon to the financial goals of their deposit base. So when their deposit base decided they needed money, the bank ran out of money and they had to sell securities. But the securities, treasury bonds, went down in value because the Federal Reserve raised rates. When rates go up, bonds go down in value. And all of a sudden, the bank came out and said, we're taking big losses, billions of dollars of losses. So we're going to try to raise money, and we're going to sell stock to the public, and we're going to do a bond offering. And once investors and depositors got wind of that, they lost confidence in the bank. And with banking, once your depositors lose confidence in you, once they question, I'm sorry, let me go back. Once they question their confidence in a bank, they've already lost confidence in the bank. So what do? They yank their money out and run. They take their money out, run to another bank. Run. See, that's where the term bank run comes from. Now, this didn't happen overnight. This didn't just happen last Wednesday night when everybody started to hear about this and the bank said they want to raise money. This happened gradually as these clients like Roku and DocuSign and other companies who are publicly traded as well, but companies that are burning through cash have to periodically and consistently take money out of their bank accounts. So this didn't happen. This happened gradually. It's just that we reached the tipping point to where the bank ran out of short-term securities to unload into the market to raise the cash to pay its depositors. And then they had to start selling their longer-term investments like treasury bonds. And that's where the losses started to rack up. And that's when the problem happened. And once that happens, and the bank didn't have enough money to give its depositors their money, once the bank couldn't sell the securities for the right price because they're taking losses on them, the bank became insolvent. And it happens that fast. It happens like that overnight once you get to that tipping point. So it's basically finance, it's personal finance 101. The bank should have matched its typical customer base with its financial goals and time horizon, which would have said the risk tolerance is zero. This they should never have done this. So why did the bank do this? Because it was very profitable. And while interest rates were low, the bank was making a mint doing this because they were earning a good net interest margin. In other words, when they pay you a little bit, but they make more money on your deposits when the bank invests that money, that spread that the bank makes is called the net interest margin. The net interest margin, NIM. And that's basically how banks operate. Now, the big banks, like the Citis, the JP Morgans, and it's a lot of the big regionals, they have more diversified lines of businesses. They have wealth management, they have mortgage departments, loan origination, credit cards, stock custody, wire transfers. They do a lot of other things to make money, but we're just focusing on basic banking, which is what Silicon Valley Bank is. It's a basic bank, but they invested in the wrong securities based on their clientele. And that's really what happened. This is not the fault of the Fed. I know a lot of people say, well, the Fed will raise rates until something breaks. That is true. And something broke. But a lot of banks are getting through this without a problem. This is something that I think is specific to Silicon Valley Bank and a handful of other banks like First Republic, Signature Bank, which was closed over the weekend, a New York-based bank. First Republic is a San Francisco bank, and they had a similar business profile to Silicon Valley, and PacWest, and there's a few others, Zions, that really took it on the chin. And now the big loser here, well, there's a couple of losers here. So now with our understanding of what happened with Silicon Valley Bank and what caused this, there's a couple of things that I have my notes on that I want to go over, okay? So tomorrow morning, we're getting the Consumer Price Index number, the big inflation report. It's the last inflation report before the Fed's next meeting. I think tomorrow's inflation report is not going to be as meaningful because this whole point is about if the Fed is raising rates and they're breaking things now, and it takes about a year for the Fed's rate hikes to slow down the economy. Well, the Fed just hit a year anniversary last week when it started raising rates. And it's raised rates a lot, way more than it's ever raised in this compressed amount of time, except for maybe with the exception of 1980 or 81, okay? But this is a lot. And now that things are breaking, it really does behoove the Fed to not raise rates when it meets next week, the 21st and 22nd of March. The 22nd is on a Wednesday. It's a two-day meeting, but around 2 o'clock, you'll find out if the Fed raised rates or not. The betting was the Fed would raise a half a point. Now the betting is the Fed raises a quarter point, but there are a lot of people who are saying the Fed doesn't do anything, and this could even mean the Fed gets to cutting rates. Now the CME, the Chicago Mercantile Exchange FedWatch tool, is actually saying that the Fed could cut rates by the end of the year. So I'm not really sure why the Fed would raise rates 2 or 3 more times now just to cut them in a couple of months. So there is a school of thought that I'm subscribing to. Goldman Sachs is big on this also, that, excuse me, you've been putting up with my cold for like a month and a half. I appreciate it, guys, right? It's the winter. So, it's almost over. The thinking is the Fed doesn't raise any rates, but it's just going to leave them at this high level for a while and see how things play out. Okay. Who's to blame here? It's the management of Silicon Valley Bank. It's not the Fed. We as investors, we as financial professionals, you as a consumer, we're supposed to weigh all of the stuff to make the best financial decisions for ourselves. But this is not, I think, the fault of the bank. There was an article on CNBC what the Republican presidential candidates are blaming this on. One is blaming it on wokeism, woke at the bank. One is just blaming Biden, saying the whole economy crashed and it's the worst economy we've ever had. Although unemployment's at a low. Another one is saying this is, taxpayers are going to be on the hook for this. We should never have done this. All right. Well, first of all, this is because Silicon Valley invested too aggressively to make more money. And basically, they were running a hedge fund, not a bank. Okay, just want to get that straight. You could go with whatever you want to go, though. I'm not going to. It's up to you. Whatever you want to believe, whatever the fault is. I'm giving you what I see. Okay. The loser here are the small and regional banks, because small banks and regional banks got absolutely crushed. And I have those up here, so I'll just share my screen real quick. Hold on a sec. All right, that's better. Okay, so guys, don't drop off the call yet. We're doing this, all right? The IAT, the iShares Regional Bank ETF, was down 6% today. The XLF, that's bigger banks, the S&P Financial Services sector, was down 4% today. So big banks, small banks, everybody took it on the chin today until people could figure this out. Now, why, if the Federal Reserve, FDIC, and wait, I just want to put a quick comment up here because I live for this stuff. Okay, I knew I would understand you better than watching the news. Thank you, Mitch. Thank you, Rian. That really means a lot to me. That is my goal, by the way. So I really appreciate that. Thanks so much. So why are the other banks down? Because the FDIC, Treasury Department, and the Federal Reserve last night got together and said, we're protecting all the depositors of all the banks. You don't have to worry about it. This does two things. You wonder if FDIC insurance is now irrelevant up to $250,000, because if your deposits are insured and protected, then they're insured and protected. I know with my bank clearing agent, I use Pershing through Bank of America. We have something like $75 million of insurance on each account. And any account that has more in it than that, the firms just buy more insurance to protect the account. I don't know why banks don't do that. It's kind of, especially Silicon Valley Bank, but maybe it encourages risk taking. I'm not really sure what the whole thing is. Okay. By the way, I see David out there. David, thank you so much for joining me. The other banks are down because, first of all, like First Republic is down a lot, and I just want to get to my. I'll show you all the banks that I follow. Feel free to take a screenshot. I have them in order of worst to best. So First Republic was down 61% today. Do you see that? I'll make it a little bigger. All right. So First Republic was down 61%. KeyBank down 27%. Zion Bank 25%. PacWest down 21%. But Wells Fargo was down 7%. Bank of America down almost 6%. Goldman Sachs down over 3%. JP Morgan was down 2%. So why were these other banks down? Banks lend money to other banks all the time, and they charge a rate. That rate is actually called the federal funds rate. So when you hear that the Fed raised the federal funds rate, that is the interbank lending rate. And if banks start to have problems, it can affect other banks. And we're not sure how that's going to affect other banks, and investors are shooting first, asking questions later. The reason you see First Republic down so much is because if their depositors need to be made whole by this money from the FDIC, that automatically means the shareholders of First Republic are wiped out. You wipe out the stock. This is how you get out of the expression bailout. The shareholders have to get wiped out, because when a bank goes under, the people who have the deposits, if they can't get their deposits out, if you can't get your money out of the bank, you become a lien holder, an unsecured lien holder of the bank's assets, of whatever they're worth. And if the bank doesn't have the assets to give all the investors back their money, then the bank is insolvent. It is not ever expected that every single investor would take all of their money out of a bank at the same time. When it gets to a lot of investors taking money at the same time out of a bank, we do call that a bank run. And the bank has to scramble to borrow money from other banks, borrow money from the Federal Reserve through something called the discount window. But if they can't do it fast enough, or if they don't have the capacity to borrow, then the bank has to basically say, we're going under. They get taken over by the FDIC corporation, FDI corporation rather, and the bank opens the next day and typically depositors do get their money out. Like when Washington Mutual went under, which was the biggest bank to ever go under in 2008, they were taken over by Chase, and all the depositors were made whole. But the depositors are different. Washington Mutual, they were regular retail investors and clients like you and I. They weren't large companies. There weren't companies who were borrowing and money and putting hundreds of millions of dollars into the bank at a time. Now, is this a bailout of the venture capital community? I'm going to say yes, but I don't think it's nefarious like that. Like, oh, we bailed them out. No, there are companies that did the right thing, and they raise money in the capital markets. That's the whole purpose of capital formation through venture capitalists or class A, class B rounds of money raising, mezzanine financing, all these weird terms of how companies raise money. We use these terms so that we basically so everybody's talking on the same page, so that we have a so everybody's playing from the same playbook and everybody can understand what other companies are doing. It's like accounting. We all use the same accounting procedure so we can have a uniform way to understand what the numbers mean. But these are companies that raise money. Should they have been more careful where they put their money and what bank they put their money in? I mean, Roku has something like $1.5 billion of cash, and a quarter of it is was with Silicon Valley Bank. So should they have done something different? It's tough to say. Who knew that Silicon Valley Bank was doing what it was doing? So is it the regulators' fault? I think there's blame to go with the regulators. Regulators will say they were just following the rules, which were loosened a couple of years ago. But ultimately, if you have a lot of money in the bank, you've got to do your due diligence to make sure that it's a sound bank. I don't know how the regular person does that, but a CFO of a company raising money is supposedly supposed to be a little bit more sophisticated than that. Lots of blame to go around, and we're going to be hearing about this blame for the next couple of months, okay? Money will move from small banks to big banks. So this basically really questions the wisdom of having money in a small bank. So it's just going to be more money going into Chase and Wells and Bank of America and other big banks. And Citi. That's what's going to happen with that. What about the Fed raising rates? Okay, we talked about that briefly, but I do have a note here. I want to follow along my chicken scratch here, my notes. I want you to think of it this way. I don't think it's the Fed raises rates until something breaks. Credit is becoming tighter. Banks are now maybe not lending quite as aggressively as they were because now they're worried about how much money they're going to be on the hook for losses in the financial services sector. There's going to be regulatory issues. Banks are going to have to pay more money into the FDIC insurance fund, so maybe they want to see what their costs are going to go up to. It just got more expensive to be a banker. Banks' expenses are going to go up because of this. Literally, if you've ever heard of the term, a few rotten apples spoiled the barrel, that's exactly what Silicon Valley Bank did. It's a couple rotten apples. They were the worst one that spoiled the whole barrel. So it makes the expenses for banks go up for the whole banking sector, not just for the small regional banks. Okay, in fact, the biggest banks are the ones who could afford to pay the most. So I'd imagine they're going to be paying an outsized proportion of expenses to help shore up the banking sector. So that is basically what happened. Mortgage rates went down. Bond yields plunged. We saw the biggest decline in interest rates across the Treasury securities sector that we've seen since 1987. So bond yields plunged. People have real worries, or I should say, they're having PTSD from the 2008-2009 Lehman Brothers crash era. Again, I don't think that's what this is, but the thing is, back then, the regulators from the FDIC, the Treasury Department, the Federal Reserve were all saying, don't worry, everything's fine. We've got it under control. It's not going to be so bad. And it turned out to be pretty effing horrible. So nobody really trusts the regulatory authorities 100%. because when they did mess it up the last time, they messed it up. I mean, a world record for messing it up. I mean, that was just crazy. So that's what's going on. I'll have more to say about this in the coming days, so please stay tuned to the live stream. And if you have any questions about this, you know where to reach me. DM me, call me, email me. And I greatly appreciate you taking the time to spend with me on this afternoon. I'll be back tomorrow. Have a great day. Have a great night.